All right, let's take a viewer email. It's from Lauren, and the subject is Cognizant Technology Solutions versus CGI Group. Your opinion, Cognizant versus CGI.
Okay.
What do we think?
So we don't own either of these currently. I've owned both at various times in the past. Cognizant is in the consulting business and IT consulting to financial institutions and other big organizations. Cognizant and CGI are both growing at about the same growth rate, about 10%. When you look at the multiple that they trade at, virtually the same, 15, 16 times next year's earnings. The difficulty is, in the case of Cognizant, their CEO's just resigned and the company's being investigated for bribery in India. CGI is here in Canada and the US, maybe slightly better rule of law and accounting standards. I would prefer to own CGI Group. The stock's behaving much better. Relative price performance is much stronger. I'm a big believer in buy companies that are good getting better, not companies that have a problem that you hope might get fixed.
But why don't you own either? I mean, the one is obvious.
So we own in the IT services, we own Fiserv, FISV, and Fidelity, FIS. They're both specifically in financial technology. And I think that that's at the right space because digital transactions are growing 10% year over year, and the banks have held back on spending on technology over many years and are reaccelerating their spend. So I want to target that area, and I want to target digital transactions if I possibly can. And so these hit on both.
Okay. Let's take a caller right now. Daryl in Winnipeg, go ahead.
Hi, my question is on stop losses. How do you select where you place your stop loss? Do you use a technical, or is it a percentage of below your entry point? I'm just curious of where you would place a stop loss. Thank you.
Okay.
So, Daryl, stop losses I think are just so important. The first thing, the reason they're so important is it's a discipline. You can rationalize holding on to anything that isn't behaving well. There'll always be somebody telling you that you're doing the right thing, and you can dig a big hole. I use stop losses because what I'm trying to do is recognize a change in behavior. So a security has its own personality in the way that it trades, and I'm trying to recognize when a security goes from making higher highs and higher lows, which is a good thing, more buyers and sellers, than to lower lows and lower highs. So there's different ways you could do that. I happen to use point and figure price charts, which are as old as the hills. They were invented by Charles Dow back around 1900. And they help in a black and white way to recognize the shift from higher highs to higher lows, higher highs and higher lows to lower lows and lower highs. You could use a moving average. Some people do. A longer term investor, I think, should use something like a 150-day moving average. But realistically, what you have to assess is, what is your risk budget? How much can you afford to lose? What's going to make you not sleep at night? I would prefer to see a change in behavior cause me to do that, and that's why the point and figure stops, I think, are useful. And one security will be more volatile than the next, so you have to ask the question, can you take on that risk?
Right.
And if it breaks my stop loss level, then my risk budget has been spent, and it's time to go to the sidelines and wait for another trade.
Do you have a range, though, in terms of what a percentage might be for a consumer staple, as an example? You know, would that be down 5% versus a biotech you'd allow it to be down 10% just because it's so volatile?
Well, it's a great question. So obviously you're ideally trying to buy a security that's relatively close to what you think is support, okay? So I'm looking for $3 worth of upside for every dollar of downside that I take on. If you were buying a really great staples company, which doesn't tend to be that volatile, but it's in the upper end of the range, you're going to have to take on 10 or 12 or 15% downside before you get stopped out. So that's why I like to use the point and figure charts. What we do is each security has its own stop, but then at the portfolio, we aggregate all of those and say, what is my total risk to stops if I got stopped out on all of my positions? And it would be unlikely that we would allow the total risk to stops to be more than about 10% of the portfolio. Okay. If we're in a bullish environment, I might give it a little bit more space. If we're in if our market work is showing risk, then we tighten up our stops to reduce our tolerance for risk.
Okay, let me take another caller. Raul in Vancouver, go ahead.
Good afternoon, or good evening, Mr. Burrows. My question is on Medtronic. Now, I've been looking at the numbers, and the last 2 years, something strange has been happening. Their debt has gone up over $20 a share. the free cash flow is coming down, and same, it's coming down to single digits in the return on equity. Is it still a long-term buy and hold? Thank you.
So the reason that we like healthcare devices is that it is the area that is least likely to be attacked by, for instance, a Democrat in the White House. Healthcare devices are somewhat less regulated from a price standpoint. Medtronic has very, very strong market share in heart rhythm devices, which is a key and growing market. Earnings for this year should be up about 7% over last year, but it should accelerate up to about 11% next year. So this group is a strong group. Brent has been expanding in the medical devices space. The stock has consolidated between sort of $80 and $90 going back to June, which is sort of in line with market. It's sitting around the 150-day moving average, so technically it's in a good spot. But you should see the earnings accelerate going forward, and that's really what I care about, is where the earnings going from here.
Okay. We're going to be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management, answering questions about North American large cap companies. You can call us toll free at 1-855-326-6266.